Hello, Business 330 students. This is our week 4 or halfway mark of our Business 330 class this summer. Amazing. Today's date is June 27th, Tuesday, and our subject this week is capital valuation, stocks and bonds, where we get the capital for long-term investment in a company. Remember, the definition of long-term capital is money you borrow or get investor equity over quite a few years, a long period of time, purchasing fixed assets. Short-term capital or working capital is the day-to-day cash management and accounts payable and accounts receivable and inventory management of a company. We're talking about long-term here with bonds and stocks. We'll talk about those in just a minute. We'll be reviewing assignment number 2 in our weekend update video this weekend. And also I will be grading those and posting those solutions by tomorrow, Wednesday. And I'm sorry because it's a upcoming weekend is a July 4th weekend, and I apologize for giving you an assignment due this week. I tried to keep it as short as possible, just about 4 or 5, 6 questions, multiple choice, plus an update of your stock portfolio as of Friday, June 30th. So we'll be updating our portfolio this week and doing some definition and calculations involving stocks and bonds in our assignment number 3 video due July 2nd. And I apologize, but with our short schedule this summer, I couldn't get really around the July 4th weekend. So let's take a look of where we are right now in our Blackboard platform. So if we look at our Blackboard, remember all our grades are posted in the report card. You can see up to the minute where your grade average is in this class every week. So make sure you check in on that. Remember, we have our student hours again this week, Thursday evenings from 6 to 8. If you have any questions or concerns about assignment 2, or that's grades have been posted, or assignment 3, the work due this week, please know that I'm available on Thursday evening. Also, I'm available through the discussion forum and also through email. So if you have any questions as we come to the halfway point of our class. As you can see, here's where we stand course assessment wise. We've completed assignment 2, and now we head into assignment 3 and 4 over the next few weeks. This weekend, I will also post the course assessment case paper, which is due on July 30th, but I'm giving you a significant amount of time. And when you take a look at that this weekend, you'll see that you're glad you have that extra time. And I will have a special video introducing that course assessment case posted this weekend. So 3 videos. If you haven't seen enough of me already, you're going to see enough of me at the end of this week. 3 videos this week, our lecture video today, our weekend update video on Friday, and on Saturday, an introduction to our course assessment case paper. Here's our assignments. Now we have assignment 3 this week. Same format as before, a PDF and a Word doc version. Also, I've given you a sample of the portfolio in a spreadsheet this time of what we're going to be doing this week, and I'll go over that in just a minute. Assignment 2 grades will be posted and solutions tomorrow, Wednesday, and as you already know, the solutions have already been posted for assignment number 1. And here's our week 4 platform. Our learning assignments for this week, we're covering chapters 6 and 7, and we're talking about stocks and bond. Here's a review file that'll be in my lecture video tonight that you can download and use as a template to understand stocks and bonds, and then PowerPoints and explanations of those chapters. So here is our assignment 3 this week, due on Sunday, July 2nd. Again, extensions are available if you need them. It's some multiple choice calculations and answers in revolving stocks and bonds, of which many of it we're going to talk about in our lecture video today and maybe review a little bit on Friday. So one section on bonds from chapter 6, all multiple choice. One section on chapter 7, stocks, again, all multiple choice. And then the final part is your stock portfolio update as of Friday, June 30th. I want you to do 4 things. Update the portfolio value as of the market prices on Friday. Find and locate the beta of your stock in your portfolio. The beta is right in the Google Finance, right on the front page. It's very easy to get. The beta is what we'll be talking about into our discussions next week. Beta is the risk assessment of your company. Tell me how much your portfolio has gained in percent and in dollars since you began the portfolio 4 weeks ago. And then compare to the 3 market indexes as of June 30th and June 23. Did you do better than the markets up to this point in our class, the halfway point? Let's take a look at that spreadsheet, which again, you'll be doing the answers to part 1 and 2 on the on the Word document. Just highlight you don't have to show me your calculations, just highlight the correct answer. If you want to show me the calculations, that's fine too, especially if you get the answer wrong. If you show me how you came up with your answer, I'll give you plenty of points for that. And then the spreadsheet, which you'll have to add or produce a spreadsheet file very similar to what we did earlier in the course of your portfolio. And here is a sample, an example, which is also located in the assignment 3 file folder of your portfolio. Notice I've done some additional things to this, and this is what you're expected to do. You can either copy this file and update it to your stocks from the very first listing on June 9th and update it on June 30th, or you can just amend your existing portfolio file to this format. It's pretty much the same, except I've added a couple of columns. One for the beta, which you'll be putting the beta of your company in as of this June 30th week. The dividend file, which we'll work on at later on in this summer. So you don't have to worry about the dividend column in this work, but you do have to fill in the beta column for your companies. If your company does not have a beta, and they'll tell you that, just type in NA, not applicable. So here's again what you're doing. Here's your original portfolio of June 9th, where you took the closing price on June 9th, divided it into your amount of shares or amount of dollars, and you got your shares rounded to the whole number. Now something different. Now you're going to be updating your price as of June 30th, this Friday at the close of the market. And so you'll have a new price. So watch what I do here now. If I type in, let's say Apple goes up to 191 this week, we wish. All right, notice the formula is still the same as it was up here, and it calculated the new amount of shares. We don't want to do that. What we want to do now is take the stock price as of June 30th and multiply it times the original share value. So I'm just going to take my original shares of my portfolio and copy them, Control C, down to here, and notice up here where it says paste. I'm going to paste values only. So there'll be no formulas in these cells, just the values of the June 9th shares. And so those are there. See, notice up here, I have a formula to calculate those shares of June 9th. Now I have the actual shares value from June 9th. So now what I'm going to do is I'm going to take the stock price of June 30th and multiply it times the amount of shares that I purchased originally on June 9th, and I will now get my updated portfolio value for Apple as of June 30th. So notice you keep and maintain the same shares that you purchased on June 9th, and now you take those original shares and multiply it by the updated stock price as of the market close on Friday, June 30th. So price times shares will give you the new amount. So you're going to do that for all your holdings in your portfolio. And notice what something happened here. I've already have this preset. I now have a new value. So if I just had no other changes, my portfolio value went from 100,000 on June 9th to 101,387.05 on June 30th. Notice in this case, I had a gain of $1,387.05. I want to see that in your portfolio. How has your portfolio changed from June 9th in dollars and in percent? How would I calculate that in a percent? I would take the dollar change and divide it by the original dollar amount of 100,000 and I get a percent. So I had a percent gain of 1.39%. Now put those in black because I had a positive gain. So I want those not to be in red. I want to make those to be black. And so notice I had a $1,387 portfolio increase in value, which was in percent 1.39%. I want to see those calculations in your portfolio for assignment 3. Then I want you to update the Dow, the S&P 500, and the NASDAQ as of June 30th. And then I want you to calculate the gain in those indexes or loss from June 9th. Very similar to what we did here. This will not be a dollar gain, but just a numerical gain or loss. And then take that and divide it into the original value of the index to get a percentage change plus or minus. And then is this number greater, especially the percent, than the Dow, the S&P 500, and NASDAQ? If it is, then yes, you beat the market. If it's not, then no, you did not beat the market. So you'll have yes or no right here comparing your performance to the Dow from as of June 30th. So a little bit more statistical spreadsheet work, which is good for you. You all need to know it. And that's going to be what I'm looking for as an update to your portfolio on June 30th, Friday. If you have any questions about that, just let me know and I will advise you. You can call me on or contact me on student hours or just send me an email if you're having difficulties with what I'm looking for. You need to find the beta of the company this week. Do not worry about the dividend yet. So that's what I want you to do. And this file is located in your assignment 3 file folder if you would like to use it. Also this week, we are concentrating on week 4 stocks and bonds. If you open up the week 4 file folder, you'll see a video review file, which will be the subject of my lecture in just a few minutes to go over the definitions of bonds and stocks. Okay, as a review of what are the key topics of chapter 6 and 7, I'll roughly go through the spreadsheet review today, but I'll talk more specifically about it in my Friday update video. What is a bond? A bond is a debt obligation, and almost all corporations issue bonds. Why? It's cheap and it's easy to get the money. Most companies, major corporations, need hundreds of millions of dollars. Banks cannot supply all that capital because of their reserve requirements. One bank can't lend one company $400 million or $300 million. It's just too much of a risk for that institution. So corporations have an option. They can put together a conglomerate of banks to issue the loans. That sometimes can be a very big hassle because banks have their own specific risk requirements, you have their own specific credit requirements, and that can be a big hassle for a lot of corporations. So why not go out and issue the money in one full swoop as called a public auction by going to the public markets, going to insurance companies, pension funds, retirement investment houses, brokerage firms, the general public, other banks, and borrow the money in a bond. A bond is what is called a non-amortized debt. Remember, we talked about amortized debt in chapter 5, where you have to make equal payments over a period of time where the interest and principal are part of each payment. Non-amortized debt is what a bond is. You just pay interest only until maturity. So it's an interest only obligation based on the credit rating and the current status in the market of your company, and you pay the principal back at maturity. So that's what is called a non-amortized loan. You and I don't have that luxury because banks, or excuse me, corporations put up their collateral, their assets as collateral for that bond obligation, or even the amount of money that they're investing in as collateral at that assets to guarantee payment. So that's why they can get an interest only loan. So a bond is set by the current market rate of that debt obligation, usually the credit rating of the company, and that current status of rate in the market. Remember, we talked about risk-free interest rate, the current 10-year market yield. That is the basis or the benchmark for all debt. So if that rate goes up, corporate debt interest rates will go up as well. That's the market benchmark. So you price your bond in the market, you get a coupon rate, and then you have to pay that coupon. In this case, you can see on the screen a $1,000 bond. All bonds are issued in $1,000 obligations. You can go to your broker and say, I would like a General Motors 1,000 10-year bond or 20-year bond, and you can go to the market and purchase that. And when you have a coupon, that coupon is the interest rate that the lender, or excuse me, the company that's borrowing the money have to pay. So if it's a $1,000 bond and the coupon is 7%, $70 a year. Now that can also be paid every 6 months, semi-annually, $35 every 6 months. And it depends on how the bond is set up, either semi-annual or annual payments. So that's how a bond operates. What we'll talk about on Friday is what happens if I want to sell a bond in the market before it matures. How does the current market yield affect the price of that bond to whoever is trying to sell it or purchase it? But that's the definition of a bond. Now, if you go to the next tab, it talks about Chapter 7 and stocks, where a bond, your only payment is interest, and then you get your money back at maturity date. So, but the only revenue stream basically is the interest, the coupon. In a stock, two main sources of revenue stream. Number one, the dividends. Now, not all companies pay dividends, but most companies, most major corporations pay dividends. In other words, every quarter they announce, or twice a year, they announce a share of their profits will be distributed as dividends to their shareholders. That's a revenue stream. Another way of getting income or revenue from a stock is you got to sell it. You sell it. You sell the stock at market in the future, and you compare that to what you paid for the stock. The difference naturally is the capital gain. So two revenue sources really from an equity position. The bad thing about it is you can also lose everything from an equity position. You are an owner of the company, and owning stock, if the company goes bankrupt, you are getting zero. You lose it all. Whereas a bond, if a company goes in default on a bond, that's why they have the collateral, the assets. They have to sell off their assets. They sell those assets off and they pay you back the money they owe you on the bond. That's required by law. Now, sometimes it takes a little while to get that money, but eventually you get the money. In a stock, no way. You lost everything. So that's the risk involved in stocks. It's because you have an obligation as an owner to sink or swim with the company, and with two revenue sources, dividends and naturally sell the stock. So stock is, we hope, we expect, expectations, whereas a bond, it's fixed income. You know you're going to get it no matter what. So that's where the risk is in stocks. It's capital investment, it's big money, It's money that comes from all over the world to invest in your company. You can, as an individual, as you all know, you can do Robinhood apps, you can do Schwab apps to buy stock, or you can buy stock through your broker. You can buy stock through your 401k, your retirement pension fund. You can buy stock through your bank account. Wells Fargo will be more than happy to open up a brokerage account for you. So again, stock is risk, but it's very sexy. It means I own something. But there's a lot of risk to stock, and we'll talk more about that on Friday. Okay, we'll pick up some calculation examples in our Friday weekend update video. So the task at hand this week is assignment number 3, and to update your portfolio as of Friday, June 30th. Don't update it until Friday, because that's what I'm looking for, is the prices of your stocks in your portfolio as of Friday. And remember, you have to turn in 2 files. One file with your multiple choice answers from the assignment, and another file of your portfolio, including the original buy of June 9th and the updated version of June 30th. There's a sample right here in your assignment file that I showed you earlier in this video. So make sure you follow that format. This assignment is worth 10% of your course grade. And again, I am sorry I have to give you this work over the July 4th weekend. I apologize. So besides all that, go to week number 4 and you'll be able to get some information about further information about bonds and stocks from our material. If you have any questions, we have our student hours on Thursday evening. We also have discussion board, and you can send me a email if you have any questions. So that's where we stand as we begin our halfway point week. Looking forward to working with you this coming remaining 4 weeks of our class. Thanks, everybody. We'll see you this weekend. Have a great week. Adios.